Ever thought your modest savings were too insignificant to enter the world of investing? Think again. In this eye-opening journey, we're diving into the investment genius of Warren Buffett to reveal how small sums can be the seed for vast fortunes. Get ready to shift your perspective and discover how even the smallest investment can grow into a financial powerhouse. This isn't just about investing. It's about harnessing the wisdom of the Oracle of Omaha to turn your financial dreams into reality. Welcome to Investing Alpha. In today's special episode, we dive into the remarkable world of Warren Buffett, the Oracle of Omaha. Known for turning modest investments into vast fortunes, Buffett's strategies have shaped the investment landscape. Join us as we unravel the secrets behind his success and how you can apply these principles, regardless of the size of your investment. Are you ready to learn from the master of value investing? Let's begin our journey into the wisdom of Warren Buffett. In the world of investing, few names are as revered as Warren Buffett. Known as the Oracle of Omaha, Buffett's investment philosophy has become a blueprint for investors seeking long-term, value-oriented strategies. Born in 1930, Buffett displayed an early interest in business and investing. His formative years were marked by an entrepreneurial spirit, selling chewing gum and Coca-Cola door-to-door, and a keen interest in the stock market. However, it was his encounter with Benjamin Graham's book, The Intelligent Investor, that profoundly shaped his investment approach. Graham's philosophy of value investing, focusing on undervalued stocks with strong fundamentals, became the cornerstone of Buffett's strategy. Buffett's approach is characterized by simplicity and profundity. He looks for companies with understandable businesses, long-term stability, strong management teams, and consistent profit margins. Unlike many investors, Buffett doesn't focus on the stock market's fluctuations or short-term economic trends. Instead, he focuses on the intrinsic value of a business, its potential to maintain and grow profits over time, and its ability to generate positive cash flow. This method, known as value investing, requires patience, thorough research, and a contrarian mindset, often buying when others are selling in fear and selling when others are buying in greed. Central to Buffett's strategy is the concept of a business's moat. Like medieval castles protected by water-filled moats, Buffett seeks companies with sustainable competitive advantages that protect them against competitors and market changes. These could be strong brand identities, monopolistic market positions, or unique product offerings. The larger and more unassailable the moat, the better the investment. Another critical aspect of Buffett's philosophy is his focus on long-term investments rather than short-term speculation. He famously said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." This long-term approach allows for the power of compounding to work its magic, a key factor in Buffett's success. The emphasis on long-term investing also means that Buffett spends a great deal of time selecting his investments, ensuring they meet his stringent criteria for value, management quality, and longevity. Buffett's investment in Coca-Cola showcases his philosophy in action. He first bought shares of Coca-Cola in 1988, a time when the market was underestimating the company's growth potential. Buffett recognized Coca-Cola's strong global brand, wide moat in the beverage industry, and its ability to generate consistent profits. Over the decades, this investment has grown exponentially, illustrating the power of long-term, value-focused investing. In sum, Warren Buffett's investment philosophy is grounded in a deep understanding of a company's fundamental value, a focus on long-term growth, and the discipline to avoid market trends and speculation. His approach, marked by simplicity, patience, and rigor, has not only made him one of the wealthiest individuals in the world, but also a guiding light for investors seeking to build wealth over the long term. Warren Buffett's journey into the world of investing began in Omaha, Nebraska. His early exposure to the financial world was through his father, Howard Buffett, who owned a brokerage firm. This early immersion in the stock market sparked Buffett's lifelong passion for investing. As a teenager, Buffett was already a budding entrepreneur, engaging in various business ventures, including delivering newspapers and selling used golf balls. This entrepreneurial spirit laid the groundwork for his later success in the investment world. Buffett's first foray into the stock market came at the tender age of 11 when he purchased shares of Cities Service, an oil company. Though this initial investment was not immediately profitable, it taught him a valuable lesson about patience and long-term thinking in the stock market. Buffett's time at the University of Nebraska and subsequently at Columbia Business School where he studied under Benjamin Graham, further honed his investment approach. Graham, known as the father of value investing, introduced Buffett to the concept of looking for securities trading at a discount to their intrinsic value, a principle that would become a hallmark of Buffett's investment strategy. After completing his education, Buffett worked for a few years at Graham's investment firm, where he deepened his understanding of value investing. During this time, he also developed his own investment principles, which would later define his approach. Buffett's first significant investment was in a textile company named Berkshire Hathaway. Although the textile business was struggling, Buffett saw potential in the company's strong balance sheet and undervalued assets. This investment marked the beginning of what would become a global conglomerate under Buffett's leadership. Buffett's early investment strategy was heavily influenced by Graham's teachings, which focused on finding undervalued stocks that the market had overlooked. He sought companies with strong fundamentals, good earnings, solid management, and reasonable debt levels, trading at prices below their intrinsic value. This approach required meticulous research and a contrarian mindset, often going against market trends. One of the critical lessons from Buffett's early years is the importance of understanding the business behind the stock. He believed that investing in a stock was akin to owning a piece of the business, and that investors should understand the business's operations, competition, and growth potential. This belief led him to focus on companies he could understand, a principle he referred to as staying within his circle of competence. Another crucial aspect of Buffett's early investments was his focus on the long-term horizon. He was not interested in short-term gains but in companies that would provide value over the years. This approach allowed him to weather market fluctuations and focus on a company's fundamental performance. In his early years, Buffett also learned the importance of patience in investing. He understood that good investments might take time to mature, and that the market might take a while to recognize a company's true value. This patience, combined with his focus on intrinsic value and understanding the business, laid the foundation for the massive success he would achieve in later years. In summary, Warren Buffett's early years in the investment world were marked by a focus on learning, understanding, and applying the principles of value investing. His experiences during this period taught him the importance of thorough research, understanding the business, focusing on long-term value, and being patient, lessons that would guide his investment strategy throughout his career. Warren Buffett's investment success can be attributed to his deep understanding of the market and his unique approach to investing. Unlike many investors who focus on market trends and short-term gains, Buffett's strategy revolves around understanding the intrinsic value of a business and its long-term potential. One of the key elements of Buffett's strategy is his focus on value investing. This approach involves finding companies that are undervalued by the market but have strong fundamentals and the potential for long-term growth. Buffett looks for businesses with a competitive advantage, such as a strong brand, a loyal customer base, or unique products or services that set them apart from their competitors. He also looks for companies with a consistent history of profitability and strong cash flow. Buffett's approach to value investing also involves a thorough analysis of a company's financial statements. He spends a significant amount of time studying annual reports, balance sheets, and income statements to understand a company's financial health. This analysis helps him identify companies that are undervalued by the market but have strong underlying value. Another critical aspect of Buffett's strategy is his focus on long-term investing. Buffett believes in holding onto his investments for the long term, allowing them to grow and compound over time. This long-term approach helps him avoid the pitfalls of short-term market fluctuations and allows him to focus on a company's fundamental performance. Buffett's investment strategy also involves a contrarian approach to the market. He often invests in companies that are out of favor with the market but have strong fundamentals. This contrarian approach requires a deep understanding of the market and the ability to see value where others do not. Buffett's approach to investing is also characterized by his focus on companies that he understands. He believes in investing in businesses that he can understand and analyze. This approach helps him avoid investments that are outside his area of expertise and allows him to make more informed investment decisions. One of the key lessons from Buffett's approach to investing is the importance of doing your homework. Buffett's success is built on his thorough research and analysis of companies. He spends a significant amount of time studying and understanding a company before making an investment decision. This level of diligence is what sets him apart from many other investors. He digs deep into a company's history, its business model, its competitive landscape, and its financial health. This thoroughness ensures that he is not just investing in a stock, but in a business he believes in and understands. Buffett's investment in companies like Apple and American Express exemplify his deep dive approach. With Apple, he waited many years before investing, observing the company's evolution, its robust ecosystem, and its strong brand loyalty. When he finally invested, it was not because of short-term trends, but because he saw long-term value and growth potential in Apple's business model. Similarly, his investment in American Express during its financial crisis in the early 1960s demonstrated his ability to see past the short-term troubles to the company's underlying value. He recognized that despite the scandal it was embroiled in, American Express had a strong brand and customer base, which would allow it to recover and grow over the long term. Buffett's strategy also shows the importance of patience in investing. He is not swayed by short-term market trends or temporary setbacks in a company's performance. Instead, he focuses on the long-term potential and waits for the market to recognize and correct undervaluations. This patience has allowed him to capitalize on investments that others have overlooked or abandoned in haste. In conclusion, understanding the market through Buffett's lens is about recognizing value, conducting thorough research, being patient, and investing with a long-term perspective. It's not about timing the market or following the crowd, but about understanding the intrinsic value of a business and its potential for long-term growth. This approach, while requiring diligence and patience, can lead to significant returns and is a testament to the power of value investing. At the heart of Warren Buffett's investment strategy is the art of finding undervalued companies. Buffett's ability to identify these hidden gems in the market has been a significant driver of his success. He looks for companies whose stock prices are below their intrinsic value, but have strong fundamentals and the potential for growth. The process of finding these undervalued companies starts with extensive research. Buffett and his team analyze industries, market trends, and individual companies to identify potential investment opportunities. They look at a range of factors, including a company's revenue, profit margins, debt levels, management quality, and market position. A crucial aspect of this process is understanding a company's business model. Buffett invests in businesses that he understands, often referred to as staying within his circle of competence. This approach ensures that he can make informed decisions about a company's prospects and risks. He looks for companies with a sustainable business model, a competitive advantage, and the potential for long-term growth. Another key factor in Buffett's approach is looking at a company's financial health. He scrutinizes financial statements to understand a company's profitability, cash flow, debt levels, and return on equity. This analysis helps him determine whether a company is undervalued by the market. He pays particular attention to the company's ability to generate free cash flow, which is a sign of a company's financial strength and its ability to invest in growth, pay dividends, or reduce debt. Buffett also considers the quality of a company's management. He looks for management teams with a track record of success, a clear vision for the company, and a shareholder-friendly approach. Management quality is crucial because even a company with strong fundamentals can falter under poor leadership. Once Buffett identifies an undervalued company, he often takes a significant stake in it. He believes in concentrated investing rather than spreading investments too thin. This approach allows him to maximize his returns from his best ideas. A great example of Buffett finding an undervalued company is his investment in IBM. Despite the tech giant being out of favor with many investors, Buffett recognized its strong business model, its transition into emerging areas like cloud computing and artificial intelligence, and its robust cash flow. A significant part of Buffett's philosophy revolves around risk management. He avoids investments that he does not understand, a principle that saved him from getting caught in the dot-com bubble of the early 2000s. His approach to risk is also about recognizing his own limitations, which he refers to as staying within his circle of competence. Patience is another critical aspect of Buffett's investment strategy. He is known for holding on to his investments for long periods, sometimes decades, allowing compound interest to work its magic. This long-term view means he often overlooks the short-term volatility of the stock market, focusing instead on the company's performance and growth potential over the years. Buffett's investment strategy has been significantly bolstered by the power of compound interest. He understands that investments grow exponentially over time when the returns are reinvested. This principle has allowed him to turn modest investments into substantial wealth. For example, Buffett's investment in Wells Fargo, which he started accumulating in 1989, has grown significantly due to the power of compounding. His ability to identify a solid investment and then hold on to it, allowing the returns to compound, has been a key driver of his success. Buffett's philosophy here is clear. It's not just about how much you invest or the returns you generate, but how long you can let those returns compound. His long-term approach, focusing on steady growth rather than quick profits, has been a cornerstone of his investment strategy. For small investors looking to emulate Buffett's success, the principles remain the same. Invest in what you know, look for undervalued companies with strong potential, and be patient. Small investors have the advantage of being able to invest in smaller companies that might be too small for large investors like Buffett to consider. This can often lead to discovering hidden gems in the market. Small investors can also benefit from the power of compound interest, just like Buffett. By consistently investing in solid, undervalued stocks and holding onto them for the long term, small investments can grow significantly. It's about being disciplined, doing your research, and not being swayed by short-term market fluctuations. Buffett's legacy goes beyond his investment success. He is known for his frugal lifestyle, philanthropic efforts, and his commitment to giving away a significant portion of his wealth. His annual letters to Berkshire Hathaway shareholders are studied by investors worldwide for their insights into his investment philosophy and the broader market. His impact on the investment world has been profound. He has demonstrated that ethical investment practices, a focus on long-term value, and a commitment to understanding businesses deeply can lead to immense success. His approach has inspired a generation of investors who seek to emulate his strategies and principles. Warren Buffett's journey in the world of investment offers invaluable lessons for investors of all sizes. His approach, characterized by a deep understanding of market dynamics, a focus on intrinsic value, and the patience to let investments grow, has proven successful over decades. For those starting with small amounts, Buffett's story is a testament to the fact that with the right approach, small beginnings can lead to great outcomes. His legacy continues to influence and inspire, demonstrating that the principles of sound investment are timeless and universal. As we conclude our exploration of Warren Buffett's investment journey, it's clear that the path to financial growth isn't just for the affluent. It's about smart choices, patience, and understanding the true value of businesses. We hope this episode has inspired you to look at your investment strategy through the lens of one of the greatest investors of our time. Don't forget to like, share, and subscribe to Investing Alpha for more insights into the world of smart investing. Your journey to investment mastery is just a click away. Join us next time for more empowering financial wisdom.